fast-paced world of Forex trading, maximizing your profits requires strategic planning and execution. One such strategy that experienced traders often employ is trade stacking. Imagine increasing your potential gains as the market moves in your favor. That's the power of trade stacking. This technique involves adding to your existing positions strategically, allowing you to capitalize on strong trends and potentially amplify your returns. This essay will serve as your comprehensive guide to understanding and implementing trade stacking in your Forex journey. We'll delve into the mechanics of stacking, explore its benefits and risks, and equip you with a step-by-step approach to incorporate it effectively into your trading arsenal. Whether you're a novice trader seeking to expand your knowledge or a seasoned professional looking to refine your strategies, this guide will provide you with the insights and tools you need to stack your trades for success. Before we dive into the intricacies of trade stacking, it's crucial to remember that Forex trading involves inherent risks. While stacking can enhance your profit potential, it's essential to approach it with caution and a solid understanding of risk management principles. Throughout this guide, we'll emphasize the importance of protecting your capital and making informed trading decisions. Trade stacking, in its simplest form, is the practice of adding to a winning trade as the market moves in your favor. Instead of taking profits from your initial position, you strategically increase your exposure to capitalize on the ongoing trend. Imagine you've identified a bullish trend for the EUR-USD currency pair and opened a long position. As the price of EUR-USD rises, confirming your analysis, you add another long position to your existing trade. This is the essence of trade stacking, strategically increasing your stake as the market validates your prediction. The appeal of trade stacking lies in its potential to magnify profits. By adding to a winning position, you increase your exposure to favorable price movements. If the market continues to trend in your intended direction, each subsequent position you add can generate progressively larger profits. However, it's crucial to remember that stacking also amplifies potential losses if the market reverses. Therefore, a well-defined risk management strategy is paramount when employing this technique. Before you even contemplate stacking trades, a solid foundation in market analysis is non-negotiable. Just like a builder needs a blueprint before laying the first brick, a trader needs to identify potential trading opportunities through careful analysis. This involves understanding the fundamental factors driving currency movements, such as economic indicators, geopolitical events, and central bank policies. Technical analysis, which focuses on chart patterns, indicators, and price action, is equally crucial. Start by identifying a currency pair that exhibits a strong trend. Look for confluence points where your fundamental and technical analysis align. For instance, if the economic outlook for a country is positive and its currency is breaking through key resistance levels on the charts, it could signal a potential buying opportunity. Remember, the goal is to enter trades with a high probability of success, as this forms the basis for effective trade stacking. Once you've identified a promising trading opportunity through thorough market analysis, it's time to set the stage for your first trade position. This initial trade is the foundation upon which your stack will be built, so it's crucial to approach it with discipline and precision. Determine your entry point based on your analysis, aiming for a level that offers a favorable risk-to-reward ratio. This means that the potential profit you stand to gain should significantly outweigh the risk you're taking. A non-negotiable element of any trading strategy, especially when stacking, is setting a stop-loss order. This order automatically closes your trade if the market moves against you, limiting your potential losses. Place your stop-loss order at a level that invalidates your trading thesis. For example, if you're buying based on a bullish breakout, your stop-loss could be placed just below the breakout point. Remember, protecting your capital is paramount, and a well-placed stop-loss order is your first line of defense. Section 5. Building your stack. Adding positions as the market moves. With your initial trade placed and your stop-loss order set, it's time to consider the exciting part: adding positions to your stack. The key here is to add positions gradually as the market moves in your favor, confirming your analysis. Avoid adding positions all at once, as this can significantly increase your risk if the market reverses unexpectedly. Instead, adopt a measured approach, scaling into your trade as the market validates your prediction. There are various methods for determining when to add positions to your stack. One common approach is to use technical levels, such as previous highs or Fibonacci retracement levels. For instance, if the price breaks above a previous high and shows signs of consolidation, it could be an opportune time to add to your long position. Another approach is to add positions based on a fixed percentage gain in your initial trade. For example, you might decide to add a new position every time your initial trade profits by 5%. The key is to find a method that aligns with your risk tolerance and trading style. Section 6. Risk management. Protecting your stack from unexpected storms. As you add positions to your stack and increase your potential for profits, it's crucial to remember that risk also amplifies. Therefore, implementing a robust risk management strategy is not just an option, it's an absolute necessity. The first rule of risk management, as mentioned earlier, is always using stop-loss orders. Place a stop-loss order for each new position you add to your stack, ensuring that your overall risk remains within your predetermined limits. Another crucial aspect of risk management is position sizing. As you add positions to your stack, consider reducing the size of each subsequent position. This approach, known as pyramiding, helps to manage your overall risk exposure. For instance, your initial trade might be 1% of your trading capital, while subsequent additions could be 0.75%, 0.50%, and so on. By decreasing the size of each new position, you limit your potential losses if the market reverses. Section 7. Knowing when to exit. Taking profits and cutting losses. While adding positions to a winning trade can be exhilarating, knowing when to exit is equally crucial for long-term trading success. Just as you have a plan for entering trades, you need a well-defined exit strategy. This involves setting profit targets and knowing when to cut your losses if the market moves against you. One approach is to set a trailing stop-loss order, which automatically adjusts your stop-loss level as the price moves in your favor. This helps to lock in profits while allowing your trade to run as long as the trend continues. Another exit strategy is to use technical levels as your guide. For instance, if you're long on a currency pair and it encounters strong resistance at a previous high, it might be prudent to take profits or partially close your position. Remember, greed can be a trader's worst enemy. Don't be afraid to take profits when your trading plan dictates it, even if it means leaving some potential profit on the table. Section 8. Stacking in action, a real-world example. Let's illustrate the concept of trade stacking with a real-world example. Imagine you've been following the EUR-USD currency pair and believe that the euro is poised to strengthen against the US dollar. Your fundamental analysis indicates a strong Eurozone economy, while your technical analysis shows a bullish breakout from a key resistance level. You decide to enter a long position at 1.1000, setting your initial stop-loss order at 1.0950. As the price of EUR-USD rallies to 1.1050, confirming your analysis, you decide to add a second long position, placing your stop-loss order at 1.1000. The price continues to climb, reaching 1.1100, at which point you add a third long position, setting your stop-loss order at 1.1050. Finally, the price reaches your predetermined profit target of 1.1150. You exit all three positions, securing a handsome profit. Section 9. Conclusion. Stacking with confidence. Trade stacking, when executed with discipline and a solid understanding of risk management principles, can be a powerful tool in a Forex trader's arsenal. It allows you to capitalize on strong trends and potentially amplify your profits. However, it's crucial to remember that stacking also amplifies risk. Thorough market analysis, strategic entry and exit points, and robust risk management are non-negotiable components of successful trade stacking. As you embark on your trade stacking journey, remember that practice, patience, and continuous learning are essential. Start with small positions, gradually increasing your exposure as you gain experience and confidence. Keep a trading journal to track your trades, analyze your performance, and identify areas for improvement. And never stop learning, seeking knowledge from experienced traders and refining your strategies over time.